Hi everyone, this is Hui, and today's episode will discuss how to manage risk in property investment. First thing first, risk is the price that you pay for opportunity. There are some differences between being risky and taking risk. Being risky means that you don't know what you're doing in your investment journey and you are basically based on luck. Your results are very inconsistent and you depend a lot on your so-called family and friends who are not even seasoned property investor to begin with. You base on their advice, you base a lot on hearsay. One key thing is that you can't explain how you make or even lose money in your investment. Some of the example of being risky can be you're doing risky things. For instance, you actually over leverage yourself. You buy a lot of properties, over leverage, and some of them to the extent of actually faking their pay slip to actually get higher loan. In contrast, taking risk is actually opposite of being risky. The results you are getting is very predictable, very consistent. And one important thing is that you have your own knowledge to actually identify and make educated and informed judgment in terms of your property investment. And the most important thing is that you understand how you make or lose money in your property investment. Moving forward, we'll look at what are the three different ways that you can look at in terms of reducing or minimizing your risk. The first risk that we look at is when you buy the property, what is the legality risk? A lot of countries have very clear regulations to protect buyers, especially for residential properties, because when you buy residential properties, it's like a fundamental need. For example, we see in Singapore, all the sales and purchase agreement are governed by this regulation called the Housing Developers Control and Licensing Act. It's the same thing as Malaysia, where they use Schedule H. It means that all developers use standard contracts for their residential development. And in Australia, we see things like Section 32 or even a vendor statement in their land contract, which states all the info required on the land sold and the land title. There's a very robust legal system in terms of owning properties in all these countries. The second thing is that for new projects, installments are payable based on the construction schedule. The developer can only bill you or bill the bank you are taking a mortgage once the development reaches a certain construction stage. Hence, it's very important to invest in countries that follows the British common law system because it's a very fair system to protect both the landlords and tenants, protect both the owners and the buyers. The second risk we look at is during the construction stage. Your biggest worry is that whether development will be completed. There are various ways to actually reduce such risk. First thing first, you need to check the developer's track record of their past completed projects, whether there's any delays or whether they manage to complete the project in time. The developer's reputation is also very important. The second thing is that you can look at the sales volume of the project. And if you notice the project is like more than 70% sold, in the perspective of the developer in terms of their cash flow is very healthy for their project to continue and complete in time. The third thing is that I can look at the construction progress of the project. Once the project there's some form of structural completion, once the project progresses pretty well, it's going to complete soon. This also means that the completion risk for the project is actually very much minimized. Another thing you can look at is, let's say the developer actually own their own units. This is actually a very good indicator to show that the developers have a lot of confidence in their project. So all these things can actually help you to actually minimize your completion risk. The third risk that we're looking at is after the project is completed, whether there are tenants going to rent your property. So it's very important that your property itself, let's say it's a residential property, there's multiple rental options, can be the form of a young family, couples, working adults, or even expats coming from overseas. You also can target students. One important thing is that don't be too dependent on just one tenant source. For instance, let's say your property just depend on students because it's near a college, near an international school. The risk will happen when the school started to shift away. This actually will affect your rental coming in. It's very important to know that where your tenants come from. The key is that the location must be a very qualified one. Can refer to the previous video where I share how we look at qualified location. So if you are a serious property investor, Okay, always treat your property investment like a business. Employ a property manager who are professionals to manage your property. If you manage the property yourself, it will be very hands-on, hence there's opportunity cost. It can be very costly affair because there's a lot of demanding issues. For instance, like how you're going to screen your tenants properly, whether there's any rental collection or efficiency issues. So it's most importantly get a professional property manager to help you on your property management process. Hence, these are three ways to manage risk for your property investment. Thank you so much for your time today. If you like our content, please like and subscribe. And please comment in the section below what are the other topics you would like us to share in. Thank you.